I hope my internet doesn't go out. If you can't hear me very well because of my voice, if I'm speaking too fast, if I'm speaking too slow, if I have a twang and you don't like it, please let me know. So anyway, so I hope you can see my screen. If you can, just put your, I don't know, sharing is paused. Okay, just a sec. I'm trying to figure this part out. I need to be able to see. Yeah, using Zoom is pretty complicated for me. Anyway, so I hope you guys can see this. Let me just put it on full mode.
We can see it perfectly. Can I help you with anything that you wanted to see?
Oh yeah, so I just wanted to see the chat box in addition to my screen. So
oh, the chat box. Oh, so what you do,
yeah.
if you go, if you move your mouse up to the top, you'll see the Zoom sort of bar, and then you can click on the chat. So
fantastic. Thanks.
Yeah.
It actually popped up. Thanks for that.
You can either just keep it in front of your presentation, or you can just take breaks every now and then and to see if there's anything in the chat.
Fantastic. Yeah. Cool. Thanks for that. Really appreciate it.
No
so let me just hide it once more. Please go away, chat box. It's okay. That's cool. So yeah. So basically, this is an intro. It's a small, very short boot camp to fundraising for a startup. So my name is Derek Muturi, as Freya has introduced me. I founded a couple of businesses in Kenya. I'm still pretty young, still below 30 years. So I'm pretty much most of your age here. I think that's the average age in this group. So I'm still pretty young. So Hardy Fresh is basically my 14th business, but in some respects, it's my first big, professional sort of business. We were selling, fresh meat and groceries and delivery all within Nairobi. But unfortunately, this is a business of just, I'm in the process of, shutting down at the moment. But nonetheless, I'll give you my experiences instead of fundraising. So basically, the question is why raise money in the first place? So many people raise money because they need money. Some people need money. Some people want to grow. Some people want to raise money because they just want to raise money and because other people are doing it. Some people want to meet very particular milestones. So the very first question you have to ask yourself, why do I want to raise outside capital? Why can't I fund this business from my own capital or from even revenue coming in from different customers? And this is basically the need of the business. Can this business scale and grow without you raising money? And in most cases, I'd say if you don't need money to run the business won't die if you don't raise money. I would always say don't raise money. Don't be too fast to raise money. Let the business grow organically because at the end of the day, you retain ownership of the business. You're in control of decision making, you're in control of the future, basically. No one is holding a gun pushing you to grow, But if your key objective as an entrepreneur is to grow, then you might want to raise money. So this is a point where you say, there are two kinds of entrepreneurs, one who are growth minded and two who are control, oriented. So if you're control oriented and you want to, have control of your business, don't listen to anyone, be your own boss, I'd say don't raise money. If you're growth oriented and you don't mind having 1% of a big pie rather than having 90% of a very small pie, then I think it's the right step to actually go forward and raise money because the business needs the money. There are different entrepreneurs who raise money because of vanity. So there are people who are more interested in raising money than building a business. And you've seen this probably even in the States, people always raising money, $100 million, $200 million, but the business never grows, So those are vanity entrepreneurs who raise money for the sake of raising money. So if you're one of those people, you're going to have a very hard time. So just determine why you need the money. Is it because the business needs it or because you want to raise money for raising money's sake? Okay. If you have any questions, please just type it into the box. I'm going to see it down. So that's the first thing you need to decide, why you want to raise money. Then the second question is, where do you even raise money from? So, and basically this section, I think from the video, I talked about it quite a bit. The very first step, I'd say, even before you ask anyone else for money, you need to bootstrap your business. So bootstrapping is basically, you know, bending down low and tying your own shoe. You know, that is your bootstrapping. You're strapping your own boots. So the idea here is, if you've worked before, you have a bit of savings, or you're lucky enough, you landed into some family inheritance, that sort of thing, then I'd say it'll be very good for you. Sorry, are you guys noticing some noises in the background? Sorry about that. I'll try and keep it a little bit quiet on my end. Thanks, Vicky, for that. So basically, if you've had, you know, a family inheritance that you fell into, or you've actually saved some money, then you can use that money to launch your business without asking anyone else for money. So that is what it basically called bootstrapping. If you're not as lucky and you have no job, but you have a really good idea, then the first place would be, you know, go to your family and friends and fools, who I call fanatics. Ask them, hey, I have this idea. Would you want to help me out, you know, with a bit of capital, so at least I can prove my model to you? So if you have if I might have a problem.
I've removed my microphone, so just let me know if the sound is much better now. Much better, fantastic. Then it's definitely my microphone. So yeah, that goes into the bin. Thanks, guys. So if basically then you've bootstrapped, go to your family and friends and say, hey guys, I just need a little bit of money. Would you be able to give me a little bit of funding? You know, I'm looking for 50,000 shillings, you know, 100,000 shillings. That is the sort of money you ask from family and friends. You know, you don't go to a traditional investor and tell them, I need 50K Kenya shillings. You know, no one's going to give you that money. So you have to go through the right channels first of all. So once your family and friends are committed, they've given you a little bit of money, you've actually started the business. The next level of financing would be trade credits. You know, so just ask your suppliers. Cool, just a sec. So ask your suppliers, just 1 second. Okay, Freya, how do I make you a panelist? Sorry.
Don't worry about it, just ignore it. Sorry.
Okay, cool, no problem. Yeah, so basically, trade credit, ask your suppliers, instead of paying you immediately when I make a sale, would you allow me to pay you after 1 week or after 2 weeks or after 3 weeks? So basically, this is trade credit. So basically at this point, and this is what supermarkets do. You supply a supermarket and they tell you, we're gonna pay you after 90 days. So for 90 days, it's not that they don't have the money. In 90 days, they're cycling through your capital and just using that to pay employees, to pay for, you know, their space. And that is trade credit. And it's very, very powerful as a business. So even before you start, you know, taking loans, start off with trade credit from your suppliers. You know, once you've gone through that, and this is, well, it depends on the kind of business you're running, because if you need to supply fast before you have capital, then you might have to raise money against an invoice. So if, for example, you're exporting something, and that's your business model, you're exporting, say, goats to Dubai, you don't get trade credit here. So there's a point where you get something like invoice discounting. You know, you go to a bank and say, I have an invoice for 1 million Kenya shillings. My margin on this is 700,000. That's the profit I'll make. And I only need to put in 300,000. Would you be able to advance me the 300K so I can supply this order? And when I get paid, basically you guys can take a 6% difference. That is invoice discounting. So that's something called factoring, which you can go to a bank and get that if you have an invoice from a legitimate business. So then after that, the next option would be applying for different grants. So you can apply for grants depending on the kind of business as well. So right now, there are a lot of grants floating for, you know, COVID relief from different organizations, the UN, World Bank. There's different grants for women-led enterprises, different grants for youth-led enterprises, different grants for, you know, people with disabilities. So, I mean, if you fit in any one of these categories, there are very many grants, you know, available for you to apply for. So the job here is for you to find out what grant is available for me and what can I apply for, what's within my current, you know, capacity to apply for. So the thing with grants is it's not free money, it's free money, but you'll be tied to certain objectives. So you have to be very diligent on how you report to these objectives, you know. So if you're told, for example, we're going to give you a grant of, say, 10 million Kenya shillings for you to employ 1,000 youth. So here, and actually, this is actually a lot of grants are like this in Kenya right now. If you can create opportunities for 1,000 youth, we're going to give you 10 million. So you have to report every month how many people you've employed, how much you've paid them. So you have a lot of data and record keeping to do over a period of, say, 5 years through the grant period. So you have to be prepared for that. The next one, then this is now the more traditional, financing that we know. You go to a SACCO. So the problem with a SACCO is you need to have savings so that you can get 3 times of your savings. So my my hack for SACCOs is, if I don't have any capital, I can borrow capital from friends and family, take it to a SACCO. So for example, I'll borrow 1 million from family and friends, take it to a SACCO. Hopefully you need to have guarantors, get a loan of 3 million, then go back to your family and friends and give them back the 1 million, and then you have 2 million to operate with. So that is basically what I did with the SACCO, I think in 2015 and 2016. That was how I hacked the SACCO thing. Risky, but yeah, you need guarantors. If you can get guarantors, you're good to go with SACCOs. The next one would be bank loans. So this is where you need assets. In Kenya specifically, if you don't have assets, a piece of land, a logbook for a car, a house, those sort of very tangible physical assets, you will struggle to get a bank loan in Kenya. So if you don't have any assets, leave the banks alone. So once you've gone through that process, then you get the more nuanced sort of financing, So angel funding. So an angel is basically a person who's rich. In Kenya, someone who has a net worth of about, I think, 10 million, and someone who can lose 100,000 without, feeling anything, that will be an angel investor. So basically, here's the thing. If you go to a friend and ask them for 50,000 to invest in your business, in Kenya, that's actually illegal. The thing is, you need to ask for money, solicit money. When you're soliciting money publicly, not family and friends is fine, but publicly to people who you don't know, you need to only solicit money from people who are classified as, what are they classified as? Accredited investors. So an accredited investor is someone who I think in Kenya has an income of about 15 million. So if you don't have that, then you shouldn't ask people for money publicly, and the minimum they should give is around 100,000 Kenya shillings, basically. Yeah. So thereafter, an angel investor is someone who has capital to invest in private businesses. So in Kenya, traditionally, angel investors will give you 1 million shillings, 2 million shillings, and usually, they're very early funders, so they'll expect about 3 times to 4 times return on that money. So if someone gives 1 million shillings, 4 or 5 years, they expect you to give them back about 4 to 5 million, and that's an angel investor. Then once you've gone through the angel investor, and you don't have to go through one angel investor, you can go through various, 1, 2, 3, 4, 5 angel investors at the same time. So right now there are angel investors in Kenya who've come together to form a fund, and basically, they co-invest in a fund. So if, let's say we have 5 angel investors, we come together, we all pull 1 million shillings each, we have a fund of 5 million. Then jointly as angel investors, as a fund, we invest in 1 or 2 businesses. So that reduces risk for angel investors, but that also compounds their gains because they're able to invest in more businesses, they're able to do due diligence better, and they're able to keep the cost of the fund minimal as opposed to investing, one-on-one individually. So once angel investors, you've gone through that round, then you go to venture capital. So venture capital in Kenya is very, very little. So only companies like, Cellulant have been able to get this. Companies like Africa Stock in, they're there, but they're very few. So venture capitalists will only invest from $10 million to $15 million. So that's 1.5 billion Kenya shillings. So if you're not looking for 1.5 billion shillings, keep away from venture capital. Those are the very, very big funds. Then thereafter, once you're a publicly, you're a growing business in Kenya, if you have income of more than 10 million, you can list on the GEM segment. That is when you're doing an initial public offering. So this is where you allow individual people like me and you to come online, to go to the Nairobi Securities Exchange and buy your shares, in return. So you can sell 50% of your company. So assuming your company does 10 million Kenya shillings year on year on revenue, then you list on the GEM segment, you can create a fictitious 1 million shares and sell every share for 100 shillings. So basically, you've valued your company for 100 million cash shillings. So you sell those shares for 100 million cash shillings, people buy your stock, and you get a portion of that money. So probably around 60, 70 million, because the investment bank will also take money, the marketers will take money, and then Nairobi Securities Exchange will take money. So you'll get about 60 million from your business in terms of selling your stock to the public. So that's an initial public offering. So basically, those are the stages of where to raise money from. But the question then is, how much should you raise? So, and this is the crux of what we're going to talk about today. I'm going to walk you through, how to determine how much money you need, and this you do through creating projections for your business. And the main projections people use to raise money is something called, a discounted cash flow, DCF. That's what people do. So basically what you say is you estimate, so today my sales are 10 million per year or 1 million per month, for example. But I project that from next month, my sales will go up 5%. And if I do that for 5 years, my sales in 5 years will be, 15 million per month instead of 1 million per month. And then we're going to say, today I value my company for, say, 50 million Kenya shillings based on my sales. In 5 years, when I'm selling for 15 million per month, the value of my company will be 5 billion. So that 5 billion, let us discount it to today's value. And that is basically the process of, projections and a discounted cash flow. So you're raising money based on a future valuation, not your current valuation, your future valuation. And basically that's what we're going to look at today. How to calculate your runway, how to think about dilution. And basically for those who haven't raised money before, or you're not conversant with the terms, runway is basically how much money do you have in the bank to run your business over a certain period of time. So for example, if every month my company has an expenditure of 100,000 Kenya shillings, that is called a burn rate. I have a burn rate of 100,000 Kenya shillings. I am burning literally 100,000 Kenya shillings every month because I'm not profitable yet. And in 5 months, I will have burnt through 500,000 Kenya shillings. So in 1 year, I need a minimum of 1.2 million in the bank to run my business without a headache. That 1.2 million is my runway. So basically, when you're raising money, you're raising money for a certain runway. So people raise for 1 year runway, that is 12 months, 18-month runway, 24-month runway. People don't raise money for 3-year runway. You raise money for short-term runways, So 1 year, 1.5 years, 2 years maximum runway. That is what we call runway, and that's what we call burn rate. So basically, that's what we're going to talk about. But also, we're going to talk about how do you actually raise money? How do you become investor ready? How do you create an investor pipeline? How do you prepare a pitch deck? What is a teaser? How do you do a business proposal? And then who are the gatekeepers in this industry? How do I get access to this money? And how to also participate in roadshows, So that's basically what we're going to cover in today's content. So without further ado, I'm going to jump right in. So just 1 sec. Let me move this forward. So yeah, we've talked about why raise money, and for most people sometimes, and yes, you're right, Raphael, even with assets, you're going to struggle with bank finance. I was there. It's very true. So the question is, why raise money? So for very many people, thinking about starting a business, most likely you're already employed somewhere else. You already have a job, a daytime job. And the idea is, if you're working at your job, there's an opportunity cost. You can't build your business fully to the extent that you'd like because you already have a job. So it's sitting up into your time. And the most fundamental reason why a lot of founders raise money is so that they can quit their day job or leave alone the side hustle and go focus on the business. Case in point, in 2015, I had about 3 side hustles. So out of these 14 businesses that I was running, 3 of them were side hustles. And Hadi was one of them. And the idea was Hadi had such a good, it seemed like a really good business, It seemed like it had a lot of hope. We were gaining traction very fast. And we figured if I was able to concentrate on this business full time, I'll be able to do revenues 5 times over, what we currently did. So why we raised money initially was I needed to quit my side hustles, quit my interning job at the NILAB at the time, so I can focus full time on the business. So that's one really good reason why you should raise money. So if you're at a job and you don't want to live with the stress of, tafukuzwa home because you don't have rent. Your wife or your husband will leave you because you have no money. So just living without that pressure. You can raise money so you can focus fully on your business. The second reason is you're growing at 1-2% every month, but your business has such a good potential that you can grow at 10% every month. So that's a really good reason to, raise money. So you can pay for advertising, you can pay for marketing, you can hire salespeople and accelerate your growth from 2%, say, to 15-10% month on month. That's a good reason to raise money. Your business is very capital intensive. You need to buy machinery upfront because, for example, if you're in printing, you can't print if you don't have a machine, So you can lease out a machine, but if the cost of leasing is more expensive in the short term than the cost of buying a machine, you'd rather just buy the machine. Otherwise, it's better to lease. So if you have a very capital intensive business, then you need to raise upfront capital for sure. Then it's very popular that companies that raise money are more serious and more accepted as legitimate businesses as opposed to those that haven't raised money. So this is one aspect why a lot of people in the US, for example, will raise money just to become legitimate. You don't want to be a briefcase sort of business. So when you go into a room and you want to ask your bank for money, and you tell your bank, UN has funded me, or the World Bank has funded me, or IFC has funded me, they look at you differently, So even though they wouldn't give you money initially, but now they look at the people who are backing you, and they have a second opinion about you. So legitimizing a business is actually also an important reason why people raise money, But probably you're running a business and it's profitable, but you have very thin margins and you're afraid that you're going to run out of money, because you want to make upfront investments down the line, So just to protect your liquidity, some people will raise money so they have more money in the bank and they don't have to live with the stress of, we only have 2 months of runway and then we die. So liquidity is one good thing. The last reason I think of why raise money, if, for example, you're an e-commerce business competing with Jumia raises 10 million. Then the next business, say Safari.com, raises 300 million. If you don't have money to compete with these people, you are basically out of the game. So if you have a better value proposition, you'd be forced to raise money because your competitors are raising money. So otherwise, unless you want to be outcompeted, you're forced to raise money because the competitors are raising money. So those are all good reasons to raise money. I think sometimes it's not the best reason to raise money because of certain things. So you want to be an indie entrepreneur. So indie means independent. And in the last, I think, 3-4 years, there's been a cultural shift in the founders ecosystem where people say enough is enough. We don't want venture capital because they're forcing you to grow 5 times a month. Who can do that sustainably for 1 year, for 2 years? You're going to lose your mind, You're pushed to do things just to grow. So some people do a lot of illegal things just to push growth. Some people cook their books to fix growth. So some people are saying enough is enough. We don't want anything like this anymore. So you want to be an independent entrepreneur, don't raise money. It's stressful. It's very stressful. And it's not fun, basically. So yeah. Then if you raise money, an investor will want at least a minimum of 3 times a return on the investment. So if someone gives you $1 million, they want 3 million back minimum. So if there's no way for them to recoup that money, and for sure if you take money from someone, you'll never give them back, there's no point to making that investment. Don't take the money. If that investor can't sell to another investor down the road, so if your family and friends give you money and you don't see any opportunity that you can have an angel investor come in later to buy their shares, there's no exit route for them out of your business, don't take their money, because they're going to have a lot of negative publicity with your family and friends, which is really bad. Your support system is going to fall apart. So don't take money from people if there's no exit potential for them. And sometimes the legal restrictions in Kenya, not as much, but if we were in Ethiopia, you cannot raise less than 50 things outside of the country. So if you're an Ethiopian resident, for example, and you want to raise money, minimum you can raise is 15 million. So in Kenya, we don't have this restriction, but this will be really good if we had something like this, because everyone will be raising, okay, money that is worth an investment, I'd say. So that's the reasons, I'd say, top reasons why to raise and top reasons why not to raise, So if you have a question, please just shoot it down. I'll be able to see it here, how does one best calculate valuation of the money set up for? Cool. So I'll answer that, Jerry, about how to calculate your, valuation. So where to raise money, I've already talked about this in depth, and the video also talks about this quite a bit. So how much to raise? So basically, at this point, you also have to figure out a couple of terms that we use in the industry. Something we call ask. What is your ask? So ask is the amount of money you want from an investor. Then there's something called dilution. Dilution is basically if you own 100% of your shares right now, and an investor comes in, you're going to get diluted. So you'll own now 95%, they're going to own 5%. If someone else comes in, you're going to be diluted more to like 90%, and then someone else took 5%. If you raise a lot of money too fast, you're going to be diluted to 50%, instead of another 5%. So every time you raise money, think about dilution, because you're going to lose control, and you're going to lose, you're going to lose the valuation of the company, based on the value of the company. The less you hold, then the less your net worth is as well. But this is also depending. I talked about a big pie versus a small pie. If every time you're raising money, the valuation of the company is growing, then even your small slice can be a very big, valuation down the road if you're very successful. If you're not successful, then you've just lost everything. Runway, I've already talked about runway. It's the amount of money you have in the bank over a period of time. So if you need 10 million to run your business for a whole year because you're burning 1 million every month, you need a runway of, say, 12 million a year, basically. We're going to talk about growth forecast, a ticket size, and a round size. So for example, if you want to raise 10 million shillings is your ask. So 10 million is the round size. How many investors do you want to give you this money? So depending on the stage you are, so probably you don't have access to people who have, 1 million or 10 million each. So you're willing to have people coming at 500,000. So 500,000, for example, is an investment size, for example. But if you allow people to come in at 100,000 and you're raising 10 million, you're going to have 1,000 investors or 100 investors. That is too many investors in a business, because how much are you going to dilute? Imagine how much you're going to need to report to all these people. Imagine how much you have to do investor relations for 100 investors. For just 10 million shillings, it's not worthwhile. So basically, you have to make a ticket size that makes sense for the investment size you're doing. So if you're raising, say, 10 million, I'd say a good ticket size, for one to come and participate in the round of investment of 10 million, I'd say a good investment ticket size would be 1.5 million, or even say 2 million. So for 2 million, you only need a maximum of 5 investors to participate, and you've raised the entire round. So that's the round, and that's the ticket size. So basically, I hope that's very understood, well understood. If someone doesn't understand that, please kindly just type it in the chat box, I'll say it. So what I'd like us to do is, so that we determine how much to raise, I want us to go to startuprunway.io. That is a website that basically helps people calculate their runway. I think Freya had shared this with you guys to sign up before the class. If you haven't, kindly just sign up for the next, say, 30 seconds, even as I navigate to the site, and then we can do this together. So I want you guys to have something concrete that you can take home and say, this is how I prepare, for my fundraising. So this is something that I use personally. So, it's been very helpful, and I'd imagine it would be very helpful for you if you actually start your fundraising as well. So just jump into, just a sec, new share. So I'll give you guys 30 seconds. Once you have basically, been able to jump into startuprunway.io, kindly just, you can put like a thumbs up on the chat box there, and in 30 seconds we can kick it off. Cool. Okay. Indeed. Cool. Startuprunway.io. 30 seconds, then we can jump in, guys. I see now we're 34 guys are joining in. Welcome, welcome, welcome. Esther Ndongo is asking about reporting requirements. Esther, sorry, I'm saying it, competition prize money similar to brand funds, just no paperwork requirements. Exactly, that's very true. That's very true, Esther. So Jerry, I'll still cover the valuation part. So I'll keep that in mind. Keep that in mind. Cool, Ashley is ready. And everyone else is ready. So I'll give you guys another, what, 15, well, 20 seconds, then I'll just dive in. So this is startuprunway.io. So usually when you're talking to an investor, they'll want to see projections. Projections are very important. So I want us to do this together. Okay, another 10 seconds. So Kiama Kara was asking, what are we doing on the site? So basically the idea of Startup Runway is when you're preparing your ask, you want to know how much money you want to raise. You know, so sometimes people don't have a clear understanding of how much money they really need. So you go to an investor and say, I want 5 million. And then the investor will ask you, what are you going to do with 5 million? Then you start saying a couple of things, you know, I want to buy a motorbike, or I want to buy this machine, or I want to do marketing. And they'll ask you to give them a cash flow forecast. So if you don't have a cash flow forecast because you don't have an accountant or you don't know how to prepare one, you're going to struggle getting that money. If you go to a bank, they're going to ask you for your forecast. If you don't have one, they won't give you money also. So basically what we're going to do here is we're going to create, you know, a runway for a business. We're going to create a cash flow forecast for a business, and we're going to determine how much money we need to raise. So you need to sign up for sure. You can sign up via LinkedIn or even just put an email and the password. If you don't want to use it thereafter, you can just give them a fake email. Then you don't have to give your details out to anyone. Yeah, so you have to sign up basically to the site. So for Kiama, we're gonna give you some 5 seconds to do that. Then I'll just kick off. Yeah. So that at least you have a good understanding of why we're doing this. This is part of being investor ready. So that's why we're doing this part. Isaiah is good. Encourage you to sign up. Yeah. Cool. So I'll just kick off. Kiama will join us as we go on. So the idea here is we want to create something. So I'll ask you guys to just put in your own data. Then we'll see how that goes. So put in your own data and I'll guide you through how it all works. And then we'll have something to start off with. And ideally, let me just create a new one so at least we are all together. So here, what would you like to call it? So we're creating a scenario. So we'll call this scenario new business proposal. And let's say this business is dealing in what? Let's say we are a digital agency. We are selling digital ads as an agency. So business proposal, digital marketing. So we're doing social media management for people, for example. So this is our fictitious business. Our currency is in Kenya shillings. So I'll just change that to Kenya shillings. If you type KS, you'll find Kenya shillings there. When does your scenario begin? Let's say I haven't launched the business yet, but we are in March 3rd. I'm launching this business. I'm going to launch this business May 1st. So this is a fictitious business, for example. So you can put in your own dates, for example. If you're already operational, you can put that in. So how much money did you have on that date? So let's assume for this business, I don't have any money from my savings. I have not bootstrapped, basically. I don't have a job. I haven't raised money from my family and friends. So let's say I'm starting from scratch. I have nothing. So, and many people start from here. I have totally nothing. So 0 Kenya shillings. Create scenario. So this is going to create a scenario for me. It's a business plan. If you think about it, this is a financial business plan. So let me just delete everything in here. So you're seeing this because it's copying this data from one of my other scenarios, which is a base scenario. So let me just remove this so we do this together. As hopefully I'm doing this, guys, you have more time to create your scenarios. Okay, I think that is, no. What happened here? Yeah, just delete the whole thing. Income. Delete. Okay. So probably I shouldn't have deleted it because I don't have access to that stuff. So assuming I've created this, let me just go back to this one here. So assuming you've created all of that. So the very first thing is in our digital business, what do you need to pay for? So you can create, if you have cost of goods sold, you can put that there. So us, we don't have that. So the very first thing would be, let's say payroll. So I'll create a category for payroll. So add here, you can see down here, add category. So you can create a category, put in what that category name is. So for me, let's say for this digital business of ours, the very first thing as a category will be payroll. So for payroll, what is our cost? Let's say we'll have a founder, me, for example. I'll start off with a salary of 10,000. I'll put in 10,000 per month. And I'll start taking this money from, say, June. So from the 1st of June, I'll be drawing a salary of 10,000 from this business. And I'll be doing this every month. So repeat monthly. Does this grow? Does it have a change? No, it's 0%. That is fixed. It doesn't grow, it doesn't reduce. Then let's say I'll have another co-founder. I'm going to hire a manager who is a HR manager. So hire a HR manager. I'll pay them 10,000. They'll also start taking the money from June 1st. Okay. They're going to do this every month. It doesn't grow, fixed rate, 0%. Then we need to sell. We need to sell for sure. So I'm going to hire a sales manager. I'm going to pay them 10,000. They're going to start drawing the money, say June 1st. So that's the first month to draw money after we launch the business. Repeat every month. Okay. So total for my payroll expenditure, I'm going to be burning 30,000. So my payroll burn rate is 30,000. Okay. I hope you're together on that. Then let's say we'll have a say cost of goods sold. So we're going to be designing things for people. So probably we'll need a subscription, you know? So that subscription, probably I'm using Canva. Canva is a software tool to design things. It's like PowerPoint. So let's say Canva, we're gonna be using Canva subscription. You know, so I'll just click the I to turn the thing on. So at least it's counted in. Let's say Canva costs me 3,000 shillings per month. And we're gonna start using this probably not in June because it's not a salary. We're gonna use this immediately when we launch, May 1st. It's a fixed rate. I'm gonna pay it monthly, okay? So let's say that's our only cost of goods sold. Then sales and marketing. I'll definitely need to reach out to customers. So where am I gonna find them? I'm going to have one sales representative who will be going company to market the business. So I'm gonna pay them 10,000 shillings and they're going to start the job and I will pay them from June 1st. I'm going to pay them every month as well. So that's one of my marketing expense, assuming this is not an employee, but it's a sales representative. So they are on a stipend of sorts. Then I'm gonna pay for marketing, Facebook ads, you know, YouTube ads. So let's say I'm gonna spend 50,000 to market my business on Facebook and YouTube. I'm gonna spend 50,000 every month. And then this cost will change. So as my business is growing because I'm spending money to market, then I'm going to adjust this every month. I'm going to increase it by 5%. So 5% every month, I'm going to increase of 50K, 51K, 58K the next month, like that. Then let's say for my business, I'm going to have some CapEx. I need some capital expenditure. And the capital expenditure here would be, we need to buy, for sure, we need to buy a MacBook. And why not? Every designer has a MacBook. So how do you write MacBook? MacBook. Yeah, so I'm going to buy a MacBook. It's going to cost me 100,000 because it's going to be refurbished. Can't afford a new one. I think I need to buy this May 1st, even as I launch the business. It's a single payment. It's not a monthly payment, single payment because I'm going to buy it once. Okay. But also, what else? Let's say I'm going to need a printer. I'm gonna need a printer to print different things, logos, business cards for people. And this is a high-tech printer. It's gonna cost me 150,000 for sure. It's high-tech. It's not the ordinary ones, it's high-tech. But let's say I'm gonna buy this thing after I launch and I get my first customer. So let's say August 1st, that's when I'm gonna buy it. Again, it's a single payment, okay? So assuming those are all my expenses, if you have more expenses, you can add a category, put it in there. So do this for your relevant business. If you're selling fruits, put your fruit business and your actual cost here. If you're, what else? If you run a garage, put your costs for the garage here relevant to your business again. So I'm gonna go to income. So up here, there's expenses and then there's income. So in income, this is where we're going to do financing. So we are raising money from family and friends and grants and all of that. So I'm going to raise my seed round. It's actually not even seed, it's gonna be my pre-seed money. I'm going to go to my family and friends and tell them, hey, you guys, man, I need to buy, I want to launch this business next month. Are you willing to give me 100,000 because I need to pay for, these employees, I need to buy this MacBook to launch my business. And assuming they say yes, hopefully they're gonna give you this money, assuming it's a single payment. So this is where you need to calculate your fund size, your, what is it called? You're going to calculate a round size and a ticket size. So assuming the ticket size is 100,000, that's the minimum I'm raising from each family member. And I forecast that I'll be able to raise 100,000 per month from say 4 or 5 different people. So I'm assuming I can do this every month, but until a certain time. So repeat monthly until, so for say, if I'm starting in, assuming I'm starting this March 1st, and I raise March, April, May. So every month until May 30th, I'm going to raise 100,000 from 3 different people. Then, because my business is so cool and I'm helping the community, the county government is going to give me a grant of 500,000 shillings so that at least I can create employment. So I'm assuming that I'm gonna get this money by June 30th. 500,000 single payment money in from the county. This is a grant. I don't have to pay it back. Then I'm assuming that we're gonna get a first client month 1. And this client is gonna pay for a retainer. So this is a digital business that we are mocking here. So this is a retainer from our clients who are gonna pay us 10,000 every month so we can manage their digital platform. And every month from the 31st, I'm going to bill them and they're going to pay me every month. And because we're doing marketing, I assume this business will grow 8% month on month. And assuming this is the only source of income I have from this business, that is how things look like. So assuming I have 2 income streams, one is a retainer, and then the other one would be a marketing campaign project for clients. So we'd say we'll run ads campaigns. Campaigns. We're gonna run campaigns for EABL, and the EABL for sure will pay me 300,000. Single payment, or probably every quarter. They're gonna pay me every quarter. They're going to pay me 300,000 to run a campaign for them, at least for 1 year. So this will be quarterly until the end of 2021 currently. So up to December 31st, they're gonna pay me 300,000. I'm sure that is money in the bank because we've signed a contract. This doesn't grow, it's 0% because it's a fixed contract. So assuming those are my income streams, up here you can see there's a graph. And what this graph tells you is, 1, how much money are you gonna raise? How much money do you need? Yeah, Raphael, MacBook for sure, it's the only way. So here's the thing. So what this graph tells you is, if this is a hypothesis, think about it, it's a hypothesis. These are my expenses, this is my income. And I'm launching this business with how much money? Let's see, a pre-seed financing from my friends and family and my county grant. And I'm gonna make 10,000 a year from retainers, 300,000 from ad campaigns. So for sure, this is how things are gonna play out. So what this tool allows you to do is play around with numbers and see how your decisions affect your business. So with this current scenario, my digital business will not run out of money until 2023, because with the raising of the county grant and the pre-seed and my income from the revenue from the business, I have 29 months of runway. So that is 29 months until my money runs out. So you see where this red line is here, cash zero. That is when my business dies if I have no more money. So the question then is, how do I stop this scenario from happening? And the idea here is, how do I not become bankrupt? So two things. I either make more money from my income or I raise more money. So let's go with the easy option, which is increase your revenue. So if I can change my revenue and change it month on month, not from 8%, and I just grow 12% month on month in my retainers. Do you see what happened here? Runway is long. Distant future is when the cash runs out, which means it never runs out. So if I go up here and I change this from, I want to see my money in 5 years. What is it going to look like in 5 years? And in 5 years, what you're going to see is, you see all these yellow lines, this bar yellow lines, it means I'm accumulating money in my bank account. I am making more money than I'm spending. And if I go as far out as 2025, I'm going to have 6.2 million shillings in the account, and I'll be making 1.013 million a month, every month, if I can grow by 12% month on month. And the thing is, if I'm not spending that money on useless things, and I don't change this scenario, I am accumulating money every month. Even in 2025, I'm going to have 28 million cash money in the bank. That is a very good scenario if you play it out exactly like this. But sometimes things happen, and you're not able to raise money because probably you decide, I am not spending my money on Facebook marketing. Okay, so you cap your marketing budget. You say, so you just click the I of that particular line item. So marketing, you decide we're not spending money on Facebook marketing. This is a fraud. We're not spending any money here. Against, the advice of your HR, you're not spending money there. And then something happens. Your income doesn't grow at 12% because people don't see you as much, because you have no outreach. You only grow 2% month on month. And what's going to happen here is, still, you don't run out of money, which is really good. But in 2025, instead of having 28 million in the bank, you only have 1.7 million, because you're not accumulating money as much, but you've also capped your marketing expenditure. So that is not, 50,000 is not going out every month, So this is, you can decide we want to grow organically. That is fine. You will grow organically and you won't run out of money. But at the end of the day, you've probably lost, let's look at this very well. So January 6, 2025, 1.7 million money in the bank. If I spent money on marketing and I can grow by my 12% month on month, 2025 January, how much money will I have? January 6 million. So by not spending money on marketing, you have thrown away 5 million of potential income in that timeline. Your business won't die, but you'll be you've left money on the table for not marketing. That's one scenario. The next scenario is, you're not lucky, like many people are not, and you don't get that money gradually. There's one county governor who decided this guy will not get this money. He did not vote for me. He did not vote. I'm not giving him this money. He grant a party. It's fine. Doesn't affect your business much. You will grow. You will be in debt distress here. You'll have capital distress for sure. You're losing money. And this is the point you break even, because you'll have 400,000 in the bank, which is fine. And you're earning 9,000 every month. Here, you're burning money. Here, you're earning money. So this is the point, August 19th, 2023. Basically, for 3 years from now, 2 years, give or take, you're living sleepless nights because you're not making enough money. So that is what happens if you're not able to raise money. This is how these different, actions affect your business. If you're not lucky, you don't raise the pre-seed fund from your family, then you're pretty much screwed. Because in 13 months, you have no money in the bank. So yellow lines, again, that is income. blue lines, that's expenditure. So this shows you how your money comes in, how it goes out, how it comes in, how it goes out. And all these decisions affect everything. If you don't get that deal from EABL in our business, oh my goodness, we are in problems because we have no money the whole time. And the idea is we're just expanding. And by October, you know, we are 2 million shillings in the hole. Here, you're surviving somehow, but you have a negative balance of 2 million. So meaning you have borrowed money, umefuliza, you've taken KCB Mshwari, 2 million shillings in the hole. You have no money. That is what's going to happen. But in the event that, assuming this MacBook spoils every month, Ama, you decide you need to buy 5 MacBooks because you have a big team. You have a problem. 2 months, you have no money in the bank because you spent all your money, and in May, it's your meeting with the devil. So this is what basically reporting, actually generating a cash flow statement looks like. So usually this is good for you as a CEO of a business. It gives you a very good oversight of this is how money comes in and goes out. You can create different scenarios. So this is how you can put your business plan to action and say, wow, this is how my decisions will affect this business. So assuming things are right, and I know for sure I need to buy that MacBook, I don't have a choice. I need to buy that printer. So what it means here is I need to raise money faster. So I need to raise that money from the county government, not in June. I need to raise this money in March. By March, say 17th, I need that money. What that has done, 15 months of runway. My family and friends, you have to give me money very fast. That's the only way I save my bills. And the idea here is at any point in time where you see you have a negative balance, then you know how much money you need to raise. And this is what this tool does, you know? So if, for example, here we had an expenditure, let's say we're gonna pay these people on commission and we're gonna hire a new sales representative every month. And that money is gonna go by 10%. That is a problem because in 26 months, we won't have money. So what I need to do is I need to raise more money. So come here, add a new item, new income. I will raise angel funding. Angel funding from Kijiji fund. Kijiji fund. Freya is going to give us money, and I think Freya is going to give us 700,000, for example. And if we get that money, our business is cash flow positive the whole way. There's no point we will not have money in the bank at any given point in time. That is what this tool allows you to do. So what I'd like you guys to do is just put all the data for your business in this tool, all your expenditure relevant to your business, all your income streams. And then if any point in time you have a shortfall, you see that red line. That red line I'm talking about is this one here, cash zero. If you have that, you have 2 options. Your expenditure, you can defy expenditure to a later period in time. So push it forward 3, 4, 5 months in advance because you don't have money for it. And if you still have the red line because you have no runway, you need to raise you have to raise an investment from family, friends, bootstrapping, fools, angel investment, venture funding. You have to raise money. That's the idea here. So try and do that. And hopefully any one of you who will be coming to the office hours next week, hopefully come with your tool, put in your data, then I can help you think through it, and I can help you brainstorm of, how do you make your business cash flow positive? How do you save your business? How do you raise an investment? And once you have this, you have the basic material to go out and look for money. So the thing is, you're not going to send this tool to your investor for sure. They don't want a link to look at your business. So what you do is you'll go to spreadsheet. So here you have expenses, income, then spreadsheet. So this spreadsheet, you need to download it. And what it does, it takes all the different categories: financing rounds, revenue, cost of goods sold, payroll. So whatever you put in those 2 tabs, expenses and income, is going to be generated on cash flow on the spreadsheet. So then you're going to go up here and export. Export. Once you export this is an Excel file. What's going to happen well, I don't seem to have Excel on my machine. Yeah, I need that MacBook for sure. So I don't have Excel, but basically it's gonna look exactly like this. So this Excel sheet, you send it to your accountant. This is your cash flow statement, and the accountant will make it look beautiful, and he'll know where you have a cash flow issue. And this is what you're going to present as a cash flow statement to a bank, a venture capital, a grant partner. That Excel sheet is what you're going to present. It'll be beautiful at that time, and all your scenarios will be tested out. So you know exactly where you have challenges, and this also creates transparency. And anytime you change anything here, you just come, update the expenses or income, and then export the new sheet, you know, and then you can always send that to your, you know, your accountant. So Kiama, you're asking about the red line. So the red line is really a representation of when you run out of money as a business. So we say cash flow is king. You know, my accountant gave me this statement and said, you know, profit is vanity. Profit is vanity. Cash flow is sanity. If you don't have cash flow, you're gonna go insane. You're gonna go insane because you'll be borrowing money right, left, and center. You will have sleepless nights. You can't pay staff. You can't pay employees. You can't pay suppliers. Cash flow is sanity. And I'll give you an example. Assuming our business here is not even profitable ever, it will never be profitable. Let's create a scenario for a business that will never be profitable, but you'll always have money in the bank and you'll never die. That sort of business is Jumia. I hope no one here works for Jumia, but that's a good case to look at. If, for example, let's just do this. Let's say this business burns more money than it ever has. I'll create one category here, and this category I'm gonna call it trade credits. Trade credits. I'm gonna ask all my suppliers to sign a contract in which I will pay them next month or 2 months after they supply something. So I'll be holding the revenues for 2 months and then I pay them, you know, in arrears. So I won't pay you upfront for service. So trade credits. For this trade credits, let's say here we say, let's just call it that, credits. And assuming we pay someone money, who do we pay? Who do we pay here? Let's look at, let's say we are very smart, and this marketing campaign, we won't do it because our time is very valuable. We're going to outsource this service to another digital company. So we're going to outsource all our business. We'll go out, get sales, get customers to pay us, and then we won't do the work. We will outsource our business to a subcontractor. That is our business model. So what we're going to do here is we need to pay this subcontractor. So credit credit from subcontractor. So this subcontractor, we need to pay them. So assuming EABL gives us this deal at 300,000 per month or per quarter. Let's make it per month so that it's easier. This per quarter thing is hard to track. So let's say these guys are going to give us this thing monthly. Every month, 300,000 up to the end of 2021. So what we're going to do is we're going to pay a subcontractor to do this work. So back into expenses. This subcontractor, assuming we're going to make 100,000 and then the subcontractor makes 200,000. So we need to pay the subcontractor for sure, 200,000 every month until December 2021, right? So by this date, we'll have paid them. But this money, let's say we're paying them 1 month in arrears. So instead of paying them March, when do we get this contract from EABL? EABL, this is March, let's make it March 1st. So if this is March 1st, EABL pays us March 1st, 300,000. We're going to pay this subcontractor after 2 months. So we're going to give them 60 days of credit. So we're going to pay them May 1st. So we go to a subcontractor and say, hey, sign this contract, we'll pay you every 2 months, 60 days. So May 1st is when we'll pay our subcontractor the first batch of money. So that is trade credit, right? So it's an expense to us, but we have an income. So here we have trade credits from our subcontractor. Trade credit from subcontractor. Our income is how much? It's 300,000 actually, because we have an expense of 200,000. So on top of it, we're making 100K. So how much cash flow do we have? We have the whole cash flow, 300K is all ours. We'll make 300,000 for sure. And we're making this from March 1st when ABL pays us. And we're gonna make this money until December 2021. Let's see how that looks like. December, yeah. So there we have a bit of money. We have cash flow. Okay. So what you see here is, assuming our business, we won't raise any pre-seed funding. We won't raise any money from county government. We won't raise any money from Kijiji. Freya decided she's not funding us. And even besides, we won't raise this ad campaign. So that's actually the money we're getting from. So this is already captured there. So just a sec. Let me think through this. Proceed. So proceed. Let me think about it. Turn this off, and then turn this off. So here's the thing. If we raise our friends and family round of 100,000 for 3 months, we still die in 2 months. We have no runway. But if we get this trade credit from our supplier, just like that, we get this trade credit. Now we have a whole 2 years for us to figure out our business because we have trade credits. And that is basically how you can finance your business from trade credit, just by keeping someone else's money. So imagine if after 1 year, you get another subcontractor, do the same thing. This is how supermarkets work. So this is how supermarkets work. So if you did this forever, assuming every month you did this forever, it's not until date, it's just do this forever, monthly, you will never run out of money. You will never run out of money, even though you want to be profitable. Your business will never be profitable, ever. But you will never, ever run out of money. And that is what trade credit does. It is so powerful. And even before you ask money from VCs, try and get trade credit. So I hope that has been a good intro to, doing a discounted cash flow, because basically here what you're doing is just validating certain assumptions, So, so yeah, Freya says it's sorry that she won't fund you guys because there was a COVID cut. So I think we'll do that. But basically, this is an intro to how to prepare to raise money. This is how you create a discounted cash flow. This is how you present your financial as a forecast to an investor down the road. So I'll give you guys a minute or so to probably just finish up on your deck. If you haven't done so, just join us across the next, part of this presentation. So that is basically what we're trying to figure out here is how much do I need to raise, And that's a very important question. How much do I need to raise? So once you figured that out from doing a forecast and you've decided, fine, I need to raise $500,000 because if I don't, my business is dead in 1 month, That's just how things are, So I hope you guys are seeing the screen. Sorry, let me try. Thank you, Kevin. Really appreciate it. Appreciate your feedback. It's very helpful.
Derek.
So how you decide upon how much to raise depends very much. Where are you? What stage in your business are you at? And that's the one thing you need to figure out. That's the one thing you really, really need to figure out. Where are you in your business cycle? So if you haven't launched yet, you just have an idea. You're at the idea stage. You are the only founder. You have 100% of your idea in your heart and in your mind. It's your pre-seed. You haven't even launched your pre-seed. So you only get money from either bootstrapping, get money from family and friends, people who know you. They're the only people who can give you money because fundraising is all about trust. Once you launch your product, you have this thing down, you go look for, a co-founder, for example, I tell Ali and Kevin, come you guys, man, you guys will be my co-founder. I have this idea, you're gonna share this company 50-50-50. I will build a product, assuming it's a mobile app. And then Kevin will do the sales and marketing. And then Ali, you'll go and do, you can do HR, I'm assuming, So what you're gonna do is we're gonna share this stake, 50-50 or 30%, 33% each. And then we have a company and we have a team. So I have a team and we have a company. Then every one of us, Kevin goes to his family, I go to my family, Ali, go to your family and raise money. So kila mtu, we have a target, 200,000 each. Everyone raises money from their family and friends. And then if you get money, what you're gonna do, we are going to dilute our stake. So instead of 33% each of us is gonna have 20, right? So that's 60%. And then you're gonna give all our family members combined a stake of 40%. So we as founders have 40%, and our family members have 40%. We have 60%, they have 40% stake. So that's how you raise my family and friends, and that's how you go through diluting your company. Then your company is gaining traction, things are going well. Wow, Kijiji has partnered with the UN. Kijiji is getting money from the UN as a hub, and they're starting an incubator. You go and register to Kijiji and say, hey, Kijiji, we want to raise a seed round. We are raising 5 million Kenya shillings. And this is how things look like. Right now, we are 3 co-founders and we have investment from our family and friends. Would you be able to give us 10 million for 10% stake in our business? Kijiji says, okay. So what you guys do, you dilute again. So every founder will now have 18%. Your family members are going to have a combined of, say, 30%, and then Kijiji takes 10%. That's how dilution works. Then you go past that stage, you've raised your first seed round, you go to an angel investor who's very rich, you go to Chris Kirubi, tell Chris Kirubi, you guy, man, you're old, you've taken so much from the ecosystem, it's your time to pay back, even Safaricom, and say, hey, you guys, can you give us money? So basically then you're at the seed round, you raise money from Safaricom, or raise money from someone else, So thanks, Ali. So basically a safe. And so these are all financial instruments. So I'll talk about instruments just in a second. So assuming you're raising money from all these people, how do you raise money? How does that transaction happen? When you're talking with your family, your mom, your dad, your uncle, it's just a conversation. Hey, this is a contract. We're gonna give you a contract. We're gonna give you 20% of a company if you give us 5 million. Okay? They agree. You guys sign off a contract, take it to a lawyer, they send money to your bank, and now they're shareholders. Then your lawyer puts them on the register of companies. So that usually what happens at the family and friend stage. At the co-founder stage, there's no contract. Ali, Kevin, and myself, it was just a gentleman's agreement. We sat down for coffee and decided, hey, you guy, everyone 33%. Fantastic. Gentleman's agreement, we're good to go. But once you start doing seed rounds at an incubator level, at an angel investor level, what starts to happen is you're going to transact using something called fundraising instruments, okay? So these are basically just very simple contracts that people have made a template out of that makes it easy for people to raise money. So the angel investor will give you something called a term sheet. So this term sheet is very simple. It's probably sometimes even a 1-page or a 2-page document saying that myself, assuming our angel investor is now Vicky and Freya. Those are our 2 angel investors. Vicky and Freya, as angels, are going to give our business, our digital company, they're going to give us $30,000, so 3 million Kenya shillings, in exchange for 10% of our company. We're going to sign that on a piece of paper, 1 page. And the idea is Vicky and Freya want to grow and exit. When a new investor comes in, if a new investor comes in at a higher valuation than 3 million, and we're able to raise 5 million from the new investor, Vicky and Freya will want their money back and some interest of, say, 10% or even 2x. So we'll give Vicky and Freya 6 million back. So we have to raise more than 10 million for sure. So if you're giving Vicky and Freya 6 million, we have to be left with another 5 million plus. So you give them the money, they exit, the new investor comes in and buys their stake and dilutes. So at that point, you'll sign something called a term sheet. Usually it's 1 or 2 pages long. But even before you get to the term sheet, so you'll sign the term sheet. And then when the term sheet is signed, you take it to the lawyer. They even simple instruments called a SAFE, which is basically simple agreement for future equity. So this is usually done with angel investors. So most angel investors are personal people, they're just rich people. It's an MCA somewhere, it's a governor. They're not a billionaire, they're just rich, but they're not a billionaire. So you sign a SAFE with them and say, we'll sign off this agreement and say, if we can raise money from a venture fund, say for example, what's an interesting venture fund in Kenya? Victoria Ventures, for example. If we raise 50 million from Victoria Ventures, we are gonna give you, so right now if you give us 10 million, you'll have 10% of a company, assuming a company is valued at 100 million. You're gonna have 10% of a company upfront. But if you raise money down the road, instead of giving you just 10%, we're gonna give you a discount on these shares. So instead of having 10% for your 10 million right now, you're gonna have 15%. So you have a discount of 5% on your shares. So basically a SAFE is a simple agreement for future equity. And usually the instrument for a SAFE is just a discount on the investment that you're giving the investor. So investors will take a stake in your company for future equity, and usually they'll have a discount of say 5, 8, 10% on the value of a company down the road. So that is how a SAFE works. And that's how a term sheet works, So I hope I've answered your question, Ali, about that. But once you get to that stage and you decide, you're a startup, you're a co-founder stage, you're a family and friends stage, you've gone forward and even gotten a grant. The idea here is once you get to the seed stage, that's where the real stuff happens. This is where you start signing off SAFEs. This is where you start signing off, term sheets. This is the fundraising stage proper. And once you go through the seed stage, you raise, 10 million cash shillings usually. You're good to go. You're a good business. But once you start growing properly and you start gaining traction, you're making 10, 50 million a year, you want to start raising serious money because now you want to capture a big section of the market. You're now at early stage. You start raising your Series A, your Series B. And this is basically where it usually happens with a lot of, venture capital funds. So you're past angel investors because now you want to raise 50 million Kenya shillings minimum, or you want to raise 200 million Kenya shillings. Angel investors can't give you that. You have to go to venture capital funds. So Series A, typically in Kenya, 1 million, 2 million US dollars, 200 million basically. That's early stage Series A. Series B in Kenya, someone like Cellulant raised a Series B, and the Series B I think was $30 million, so about 3 billion. So that's basically, and even then just Series B. 3 billion in the US, that is either Series A or seed stage. So different markets, different stages. So once you grow past that, you go to mid stage, you're raising a Series B, a Series C. Once you're a really, really big company, who could be a big company? So just think of people below Safaricom, but above Cellulant, people who are looking for 10 billion Kenya shillings. So actually, later stage, this will be actually a county government. So if Nairobi County government was looking for proper money, because Nairobi County government is a business, it's a business owned by the public, they should be able to raise, 10, 50 billion through a government bond. And that's also an instrument for it's a financial instrument, but you can raise it from private investors as well. So that's where you raise Series C. Then leverage buyouts, this happened way, way, way later down the road for very big businesses, the likes of Airtel and the likes. So Airtel has had a lot of leverage buyouts from guys like, Bati bought them from Telcom. So it's had really different transactions down the road. That's for serious businesses. Then mezzanine finance, a business like Safaricom are launching a venture, a private venture. They don't want to use their own money. They get mezzanine finance, 10 billion, 5 billion to launch a different venture. So that's basically how you get money down the road. And that's basically the stages of raising money. Then the question is, so you've decided, yes, I want to raise money. I'm at seed stage, I'm at Series B. How do you actually go out and raise money? And this is basically a very important process. This is where stage one, you have to be investor ready. And what does that even mean? Okay. Step two, you have to prepare your investment pipeline. What is that? And then step three, you need to know who are the gatekeepers and get an introduction to these investors. And that's basically how you you go through this process. So I'll just walk you through all of them very fast. And being investor ready is not as complex as it sounds. Being investor ready, number one, your business for sure has to be registered. You are a limited company. You're not transacting as a partnership or as a sole proprietor. You're a registered incorporated company in your region. Number two, you've prepared your realistic business plan, okay? So in the forecast that we did initially, we only showed a base case scenario. We expect to grow at 12% year on year. But what if we grow by 2% year on year? Very pessimistic. But what if we grow at 20% month on month? Very, very optimistic. So when you're presenting a business plan to an investor, you need to have a base case scenario, you need to have a pessimistic scenario, and you need to have an optimistic scenario. So the idea here is you need to know that you've thought through the good things, the bad things, and if things just are just there, you grow, okay. So you need to prepare all these different things, okay? Different case scenarios. Then you also need to have governance. You need to have a board of directors, for sure. And every business should have a board of directors. If it's your cousin, your uncle, your friend, your mentor, someone you respect, get a board of governance. If you don't have a governance board, you won't raise money. People don't trust you. People want to see accountability in a business, okay? So get a board together, a board of directors or an advisory board. If anyone has invested in you, ask that person to be in your board of directors if you don't have any. That's important. Accountability, you need to have at least filed 1 or 2 years minimum of, what are they called? Audited accounts. So you need to be audited by an auditor, an independent auditor, not your accountant, an independent auditor. So at least 1 or 2 years of audited accounts will get you through the door with angel funds and even venture capitalists. If you're raising at friends stage, you don't need this, but it's important if you have it. You need to have a proof of concept of what we call a minimum viable product or a minimum lovable product. You need to have something you can sell as a service or something as a product. So it doesn't have to be perfect, but you need something that you can take to the market, sell and transact on it. That you need for sure. Then you need to prepare your elevator pitch. What is an elevator pitch? An elevator pitch is if you're in an elevator, in a lift with an investor, you probably have 15 seconds between one floor to the next floor. How can you grab someone's attention in 15 seconds? That is your elevator pitch. You need to prepare it. You need to know it by heart. When you meet someone, that's how you start a conversation. My name is Derek Muturi. I run Hardy Fresh. We are an on-demand delivery service. We deliver groceries to households in Nairobi, connecting producers and customers, end-to-end, farm to fork. That is my elevator pitch. So what is your elevator pitch? You have to have that and know it by heart. Then you need to prepare a pitch deck. So on a pitch deck, I'll cover that in more details down the line. Before you even have a pitch deck, you need to have something called an investor teaser. An investor teaser is a one-page document, just one page. Let me show you how that looks like. It's just one page. Just one sec. This here is an investor teaser. I hope you guys can see what I have on the screen. Yeah, you can see, cool. So this is an investor teaser. Where did it go to? Okay. This is an investor teaser. One page showing who is in your management team, your CEO, your CFO, your founder, your accountant, wherever. What is your industry? We are in the digital marketing industry. How many employees do you have? 31. Who's your main banker? If you're banking with a small bank like Jamii Sacco, you're in problems. If they go down, your business goes down. So you need to have a good bank, a top tier bank, tier 1, tier 2 bank. Who's your auditor? PwC, Deloitte, or an unknown auditor, Then how much are you looking for? What is your ask? We're looking for 5-7 million cash shillings, $10 million, for example. Then what are you going to use this money for? We're going to use it for, marketing. We're going to use it for user acquisition. We're going to use it for CapEx to buy our MacBooks so we can do the digital marketing, for example. What is your projections? Our projections look like this. And you can take a screenshot of your projections that we did in the previous graph and show it here, for example. And then you can put in different things. What is your value proposition? What is your go-to-market strategy? So very short, sort of snapshots of different things in your business. Who's your main competition? We're competing against 1 to 3x people. And this is basically a value proposition to the customer. And this is our edge over those people. And the idea here is you're not giving away your entire business plan. It's just one page to give an investor enthusiasm. This is basically you dating, you're not even dating, you're courting an investor. You just want them to look at you and say, wow, I like this business. And you can even put in a line for revenue. Average revenue per year, 10 million, for example, per month. And they see that and they're like, wow, I want to get in here. How much are they looking for? 1 million, and they're already doing 10 million. This is interesting. You just want them to give you a call. And in here, you put in your phone number, your email to get in touch. This is a teaser. It just needs to be one page, nothing more. That's a teaser. Then what's a pitch deck? And a pitch deck is very simple. It's more detailed than a teaser, way more detailed than a teaser. It's a couple of pages, usually around 12 pages. And you have an introduction of who you are, what your business is, what is the problem you're trying to solve, what is the solution that you're providing, what is the market size opportunity of that market, what is the product that you're selling or the service that you're selling, what is the traction, how many customers do you have, what is your average monthly sale, how many people in your team, who are these people, where did they go to school, who's your competition, is it Safaricom or is it a small player, what do your financials look like, are you pre-revenue, are you post-revenue, how much do you make per month, if you're not, what is your projected financials in 1 year, and then how much money do you want and what do you want to use for that money. And basically that is what a pitch deck is. So this will be around 12 pages, usually, give or take. The shorter it is, the better it is. But based on the content, it's usually 12 pages maximum. Don't make it 15 pages. No one is going to listen. No one is going to read it, for sure. Then the question is, now I have my pitch deck, I have my investor teaser. What else do you need? Even before you go to an investor, you'll need to prepare something called a data room, okay? So what is your data room? So a data room is not anything complex. It is something as simple as a cloud drive on Google Drive or on Dropbox, whatever, where you have different folders for different things in your business. So you have analytics for your customers, for example. You have customer data, their names, their location, how much they transact. You have your business registration documents, your KRA PIN, your business registration certificate, your business license. You have, for team, you have the contracts of everyone you've employed, everyone you fired. For your board, you have contracts for everyone who's in your board. You have your investment deck there. For operations, you have any manuals, policies in there. Branding, what do you have for branding? What does your logo look like? You have it there. For finance, you have all your projections in there. What is your organogram? Who's at the top of your business? Do you have a board? Do you have an advisory board? Do you have a CEO? Do you have a HR? Who are under those people? What does your organogram look like? You have a picture there, okay? Cap table. This is basically who owns your company and how many shares do they own. Kevin owns 33%, Ali owns 33%, Derek owns 33%, and then Freya has 3%, for example. That's your cap table. Who owns what? And you have a pie chart showing all of that. And if this is actually documentation that is registered at the company registrar, at this point, you also have something called CR12. So that's the company registry form number 12, which shows who owns the company registered with the company registrar. Okay. So for funding, how much funding have you raised before? From who? Any term sheet that you have is in here. Any safe that you've signed with anyone is in here. Product data. What is your product? What is the picture of your product? How do you design it? Do you have intellectual property on your product? All of that information is very important. Compliance. Are you compliant with KEBS? Are you compliant with NEMA? Are you compliant with anyone you need to be compliant with? If you are, you need the certification here. Governance. So this is where your board of directors have the contracts, for example. Then if you're doing a grant, you need to do reports every single month or every quarter. Every quarter, you need the report here, for example. Any contract you sign with a third party is inside contracts, for example. Investors nowadays are very, very particular about impact. So what is your impact assessment? You need to do your impact report. How many youth have you employed? How many new jobs have you created? What is how much tax have you paid to the ecosystem, where you live? Those things are very, very important. Really, really, really important. So you need a data room. So then when an investor comes on board, they ask you for, when they're doing due diligence, when you've called an investor, they're like, we want to talk to you. This is really good. Let's have a conversation. An investor will ask you for all this data, and you can't prepare all this data for every investor. So you need to have it ready for every investor you'll talk to. So all you come and do, you come here to add, and then you put in the email, and the investor has everything they need for that data room of your company. And that for sure you will need for every investor you talk to, your family, your friends, an incubator, whoever you talk to, you will need that for sure. Okay, that's very, very important. If you have any questions, please send it on the chat. Otherwise, I'm glad that you're all following. I've talked for quite a while, so let me just do the last part. Then you guys can do a Q&A. So then once you have a data room prepared and you have a pitch deck and you have your investor teaser, what next? You don't go to an investor and talk to them. No, you need something else. You need something called an investor pipeline. So think about it this way. Assuming in your class in uni or wherever you are, before you approach a chick or a dude, sometimes you need to scope them out. You need to know things about them. So you go online on Facebook, you research on them, and you need to do the same thing with an investor. This is a long-term relationship. 5-6 years with an investor, it's long-term. You need to know who you're getting in bed with, not in literal terms. But you need to scope them out properly. So you go, think about, I want a grant. Who gives a grant for youth-funded businesses? Who gives a grant for digital startups in marketing in this ecosystem? So what I'll end up doing is I'll look at my competitors and see who has given them money before. For example, assuming we are in our digital business here, I'll go look at any other digital business, like say Scanad. Scanad is the biggest digital business in Kenya for marketing. Who has funded them? Nation Media Group, for example. I'm like, fantastic. So Nation Media Group gives money. So I'll go create an Excel sheet. This is my investor pipeline. I'll put Nation Media Group there as one particular person to actually go out and look for. And then look for someone else. I'm like, okay, who's my other competitor? Redline Media. They also do ads. Who has funded Redline Media? I'm like, wow, these guys have been funded by Skyline Designs, for example. Go looking for Skyline Designs, put them in my Excel sheet. I'm like, I need to talk to Nation Media, I need to talk to Skyline, and I even need to talk to an incubator like NILAB or Kijiji or UNDP, Youth Aggregated Fund, something like that. So I'll put that in my Excel sheets, okay? So the key thing you need to know is globally, only 3% of startups are funded. In Kenya, it is so bad, less than 0.5% of startups in Kenya are funded. Less than. And that data still is not very accurate. Less than 0.5% of businesses are funded. And the key thing you need to note is it's usually not about how good your deal is, how good your idea is. It's not about the business. And I think over the last 2-3 years in Kenya, we've had this conversation on LinkedIn and on different fora where we say only white people are getting funded. It's not that only white people are getting funded, even black people get funded. And the key thing you need to realize is, and you've had this many, many times, and the phrase is usually like, your network is your net worth. Fundraising is not about your business to an extent. Your business does not matter that much. What matters is who you know, okay? So if there's anything you're gonna take out of this training today about fundraising is not about your business, it's about who you know. It's about your network. And this is the most fundamental thing I've learned. I think over the last 4 years, I've talked to probably 200 investors in Kenya, in the US, in Europe. And of all the investors I've talked to, only the ones I was introduced to by someone who trusts me and someone who trusts the investor invested in my business. Only those ones. Any investor I went and emailed, any investor I went and wrote an SMS to, any investor I went outside their office and sat there for a whole day waiting for them to read my deck, did not listen to me and did not even invest. Investments happen through trust. Trust is through your networks, through an introduction. So if there's anything you're going to learn out of this conversation today, you need to build your network. And to build your network, you need to get aligned with who the gatekeepers are, okay? So if you talk to 100 investors with the statistics we have, only 1 or 2 is likely to invest in you. So if you want to raise an investment and you talked to 10 people, there is no chance you'll raise an investment ever. There is no chance based on statistics. You need to talk to 50 people to even have one interest, okay? So you need to talk to so many people to raise money. So if you're thinking of going down the investment route as a startup, one person in the team, it's a full-time job raising money. Full-time job. They can't be the one doing customer calls. They can't be the one doing product development or sales. If you're fundraising in a startup, usually this is the job of the CEO. It's your full-time job. People usually wonder, what is the job of a CEO? In a startup, they have one job, not to keep the team together or anything. That's the job of another manager. The job of the CEO is to raise money. It's your full-time job to do your investor pipeline, get 100 people in your pipeline. So you're talking to someone every single day to give you money. A grant, you're writing grant proposals, you're researching on different things. So, and once you know this, just clean, rinse, repeat the whole process over and over again. And the reality of this is, if you're looking for a girlfriend or a boyfriend and you text them, you're going to get rejected. But that doesn't mean you won't get married. So just keep trying, you're going to get something out of the day. You know, you have to be consistent, you have to be persistent. Okay. So basically the idea here is then, who are these gatekeepers? How do we get these introductions to investors? Because emails won't work, sending them a text on LinkedIn won't work, going and sitting outside the office for 3 days won't work. How do I raise money? So hustle for introductions, not investments. But who are you hustling this interest from? You're going to hustle this interest from gatekeepers. The easiest gatekeeper to hustle an introduction from is another founder. Look for a business that is like yours, or even if it's not like yours, who's been funded by someone you're looking at. Get to know that founder. Buy them coffee, buy them tea, buy them whatever. Get a conversation, get a sit down with them, ask them to give you information about a particular investor. Ask them to introduce you to this investor. So founders are very, very important. And founders are in an ecosystem. In Kenya, the startup ecosystem is very small. Every founder knows every other founder. So get to know another founder. Where you can find these founders usually, go to any incubator or any accelerator, go to their website, look at everyone who they have ever incubated for the last 5 years. You're going to have a list of probably 500 names. All those are founders. Even if their business doesn't exist today, they are probably funded by someone yesterday or 1 year ago, or they are working for another startup that has been founded. Those founders can give you introductions to founders or other investors, for example. The next best people is go to an incubator themselves, get incubation. So when I was starting my business, even before I started Hardy Fresh, I knew the only way I was going to get money was to work through an incubator. So I applied to NILAB to be incubated as a business, and they rejected my business because I wanted to farm rabbits and they didn't like it. So I went there and applied as an intern, and I worked for them as an intern for 3 months, and they got to like me and they liked me. And finally I presented my business as an intern, and I quit as an intern and I started, running my business. And NILAB invested in me, and NILAB gave me introductions to new investors in Kenya and outside Kenya. And basically that was my inroad. That was my door open for investment. So go to an incubator, go to an accelerator, and there's so many. You can find these guys online in Kenya right now. If that's not your forte, if they don't take you in, there are very many marketplaces. So the first one I'd say is Venture Capital for Africa. So that is VC for Africa. Go check them out online, VC for Africa. That's Venture Capital for Africa. Register your business, register your profile, and basically what they do is a marketplace for investors and entrepreneurs. Investors are always looking for opportunities. Entrepreneurs are also always looking for investments. So basically what they do is they try and match your business to an investor. So register there, and if you're looking beyond, VC for Africa. Yeah, so you just write VC for Africa, VC for A, something like that. VC for Africa. Yeah, something like that. Just type it in, you'll see it online. VC for Africa. If you don't want to look into the African market, but I'd say if you're registering on VC for Africa, register to all of them. Go to Crunchbase, go to crunchbase.com, and basically here you're able to get, investors from outside can also see you, it's not just guys from Africa. So register on Crunchbase, register on VC for Africa, register for European investment firms as well. I've not used European marketplaces usually, just the American ones and African ones. I think even here locally in Kenya, they're there. But yeah, so you can always try and match that as well. Look through the media. Every time you see companies getting funded. So Cellulant got funded. The question is by who? So instead of looking who funded Cellulant, the 3 billion, go back in time and see who funded Cellulant, their first 10 million, who funded Cellulant, their first 50 million. Those are the investors you want to talk to early on, not the 3 billion guys who funded them. It's those 10 million, 5 million guys who entered very, very early on, 5-10 years ago. And those are the guys you want to talk to. So look for any company that has gotten funding and then try and track back who funded them back in the day when they didn't have money, or they were not very popular. That's how you get information, And then this other one, this is the last one that I learned just the other day. Private Equity Support. That is a company, PES. Private Equity Support in Kenya knows every investor in this market. Go link up with them. They have offices in town, I think right next to Kenyatta Hospital, somewhere there, Nairobi Hospital rather. Private Equity Support, PES. Ask them for referrals, but before you ask them for referrals, ask them to help you become investor ready. And they will give you these introductions, okay? And I think for now, that is what I had for you today. It's quite a bit of content, but thank you for following through over a very long time. I really, really appreciate you guys. Yeah, and thank you for all the questions and for your participation and for your patience. This has been a very, very long engagement, but I really, really appreciate it, guys. So thank you so much. It's been a pleasure. Hopefully we'll interact here and there. Thank you for all the feedback that you guys have been sending on the chat box. It's really, really good to know that this has been helpful to all of you. So thank you so much. And it's a pleasure. So back to you,